Hello, my name is Laura Burkhardt, and I am here with Joshua Cooper, who
Hello.
is a CPA. Hello. He is a CPA, and he's worked with yoga teachers and outside of yoga teacher world with people with other professions. And he is here to talk to us about finances as yoga teachers, studio owners. Okay, so why don't we get started? Joshua, why don't you let me know, tell us about your background, both in the yoga world and as a CPA.
Okay, so I am a CPA and I've got my own CPA firm, and I work a lot with yoga teachers, yoga studios, and people in that realm, even further down in the artistic and fitness realm. And I have for years. I'm also a yoga practitioner. I used to be an accountant for Yoga Journal, the magazine. So yoga has kind of been a big part in my life and how I have designed my business and my practice utilizes a lot of the stuff I've learned in my yoga education throughout the world. So I feel like when clients who are yoga teachers and yoga studio owners, they actually, believe it or not, have a leg up on a lot of other business owners because they already have established what is in the realm of a practice. And so it's just more just highlighting and shining some consciousness onto that practice in the accounting world. So that's what I do.
Wonderful. I love that. I love that. And so when do you think is a good time as a yoga teacher? Let's say someone just dives into teaching in the yoga world. When do you think is a good time for them to seek out a CPA? Like, is there a certain time? Or I know for myself, I get so many different like W-2s and 1099s and things like that. So is there a good time you think it might be good for someone to seek out a CPA?
Yeah, I do. I think there's, you kind of highlighted that a little bit, but there's really two ways that you get paid from being a yoga teacher. One is as an employee where you get a W-2, and another one is as a contractor where you get a 1099. Most studios these days are leaning more towards the W-2 employee model, even if though you're part-time. So we're seeing more of that in that realm, but you could get both. The time to seek out a CPA or someone to help prepare your tax returns is generally if you are receiving 1099s in that realm in the income, because then you're actually having to report your income and expenses separately. As soon as you step into that realm of having to keep track of your expenses, it'd be nice to at least consult with a professional to make sure you're not leaving anything on the table, certain expenses and things like that. You can still claim expenses when you are an employee, but they get washed out a little bit. So oftentimes it's not 100% necessary. So if you're just getting one or two W-2s and you're starting out, I think you can probably still handle things on your own, unless you had major expenses. So a lot of times people will, and I'm diving into other realms very quickly, but like, just for example, you might have a very large continuing education expense. I mean, one of the things that the IRS is just now getting used to is that there's a profession called a yoga teacher that spends all their money on education for themselves, which is mind-blowing to them. So like for years, like 10 years ago, they thought, how's this possible? These people are trying to pull a fast one. But no, they're actually traveling to Bali and spending all their money trying to learn more yoga. So they're not used to that. So sometimes that's a really big expense that you want to be able to show on a tax return. That may be something you want to start to seek out professional help for at that point.
Well, speaking of things that you can write off for taxes, what are some of the things that teachers may know or don't know, or like what can we write off for taxes and what is something that we can't write off for taxes?
Yeah, I mean, the biggest expense that I see is continuing education, and that can be in the realm of actual retreats that you go on. It could be visiting other yoga studios and taking classes, all those kind of typical things. But then there's tier two, which are things that are just making you more aware of your body and how to touch other people. So sometimes massages and acupuncture. These days, yoga teachers are almost being required to have some knowledge about almost every modality on the planet. And so especially if you're going to put your hands on someone and adjust them, people have even written off massage school, going to massage school in that realm, because of there's a lot of hands-on kind of movements in the body, and a lot of yoga teachers are great yoga teachers but don't know actually how to physically touch someone. So that kind of enters that realm. And even to be able to speak to chi and different prana and energy, sometimes you have to take some acupuncture courses or get acupuncture treatment so you can do that. So some of those realms, continuing education is a big one. But like I say, on all tax returns and things like that, you can have an expense in a category like continuing education, but whether or not you take that entire thing in a given year depends on the overall picture of your tax return. For example, if you added up all of your acupuncture, massage, yoga classes, and you came up to $20,000 in one year, that might be a little bit high. Even though it's all accurate, there still comes in this play of like, well, should I still claim it all? And just putting that out there, because there's different realms in that. So that's one big one. Another one is like automobile. So a lot of yoga teachers are constantly on the move, because especially when they're starting out, they're like in 6 different studios, and most yoga teachers have their home office, and that's kind of like your hub. And so anywhere you drive outside of that is in that route of the day, you can write the mileage off of that. And not only that, if you have to eat a meal during any part of that route, you can write off that meal as well. So a lot of people think that the meal expense is only like if you're wining and dining future clients and stuff like that. That's not the only realm there. It could be in the natural course of your business as a requirement that you eat while on the job kind of thing. And so there's room for that as well. And that also plays into entertainment. Entertainment is a whole other concept for a business expense. The category for the IRS is called meals and entertainment. It's all lumped together. Entertainment would be something if you went into different concerts or stuff like that, or museums that technically is supposed to be in the realm of generating business. So for Burning Man, for example, would fall into that category, because it's not necessarily a yoga retreat that you're going on, but there's enough potential clients, enough marketing, networking situation there that you could write that off in the meals and entertainment category.
Mm-hmm. Yeah.
Yeah, besides that, clothing is another great one. The way clothing works, there's not a lot of professions that can actually write off clothing. Even though I normally don't wear a collar shirt when I'm hanging around, I still can't write off all the stuff I wear at work because I'm not in that industry. Fitness people and yoga teachers have a little bit more of a leeway there, because generally you have outfits that are designed for you to be in when you're teaching yoga that you technically would not wear outside of that environment. Now that line has been very thinly drawn now that the yoga apparel wear has taken off, and most yoga teachers, all they wear is yoga clothes because it's the most comfortable stuff and it's super stylish now. So that line is a little bit, I say it's a great line, because you can almost write off your entire wardrobe because it's all, from yoga teaching. But again, you don't really want to write off your entire wardrobe, but most yoga teachers can't spend that much on wardrobes anyway. But it's hypothetically you would be allowed to, because it's all uniform expenses, which again, only certain industries can even utilize that now. Doctors, nurses, people in the fitness world and things like that, but the general rule is that the article of clothing / uniform that you're wearing, you wouldn't wear outside of that work environment. That's the rule, though it's very hard to prove that in the yoga world, because it's all yoga pants.
Right. Yeah. Yeah. So what's interesting you were saying about, I never knew that about massage. Not that I hardly ever get a massage because I'm a yoga teacher, and I sometimes don't have an extra $100 or more dollars, but it does bring up something to my mind is, what about if someone has an injury and let's say they do need to go to acupuncture, they do need to go to physical therapy, etc. Would that be considered a tax write-off?
It's a little trickier when it's a medical need.
Okay.
It is a tax write-off, medical, doctor visits. It falls more into that category.
Mm-hmm.
It's not a business write-off.
Mm-hmm.
It's written off somewhere else on your tax return.
Okay.
It gets into a whole nother realm, which I think is outside of the course of what we're discussing here. But so my first answer is probably not. Maybe the first one or two could be, because you want to, if somebody's like, you tore your ACL and I've had a yoga teacher who tore their ACL playing ultimate frisbee. And so they had to do some major rehab with that. And we wrote off a good portion of it, not the whole thing, because they ended up specializing and writing a whole course on yoga for ACL rehabilitation.
Mm-hmm.
That was a different situation. If it was just normal, you hurt your shoulder and you're getting some physical therapy, that really falls in a medical expense and should not be deducted against your business.
So business expense, I guess, depending on how you use your living situation, that could be considered a tax write-off. Your phone can be considered a tax write-off. Your gas. You told me not your car, because I just got I got a car because mine died, or it didn't die, it got totaled.
And then I want to correct if I did say that, because you can write off your car. The way that automobiles are written off is a little bit intricate. So you're actually given two different scenarios that we often run kind of parallel to each other. On one side, it's, I want to calculate the miles that were driven, and there's some formula that says, okay, well, that's going to be a $8,000 deduction. On this side, and they call this the standard deduction, because you're kind of using this IRS standard. On this side, we would basically take the total cost of your automobile, your gas, and all that, and take your business use percentage of that and figure out what that comes to. And then we can compare at the bottom and see which one is greater. A lot of times people just go with the mileage one because it doesn't require keeping track of all your gas and all your repairs and stuff like that. But oftentimes we look at both. So if you bought a new car, then technically looking at potentially this actual one might make more sense in the current year. It still may come up more that you did. Either way, you want to keep track of your miles. Mm-hmm. And so that's something that you've got to either keep a record of on some way on a calendar, or there are even apps that do it, Mile IQ and stuff like that, that do that for a lot of people who are in the car for a lot. So yeah, so you can definitely write off the purchase of a car, even if you're leasing it. A lot of people will say, should I buy a car or should I lease a car? And it's like, if you're running your own business and you're like filing a Schedule C for a self-employed person, then you're going to get benefit either way. Mm-hmm. Oftentimes, for the last few years, buying a car has let you write off more in the current year. You could kind of take a little bit more now and not take it later, kind of thing. Although the tax laws are changing greatly, so we'll see where that lands. But either way, you could write that off.
What about let's say someone doesn't have a car? Let's say if they're using something like a bus, or they're using Lyft, something like that, to try to get to their classes. What about that?
Yeah, 100%. Any sort of BART, mass transit, bus, Uber, Lyft, that's all transportation expense, travel expense.
Okay.
It's 100% write-offable.
Okay.
Some people have a combination. They've got the Uber ones because it's just inner city, but then they've got to drive 20 minutes for that one private class for that one person's home and drive back. So there could be an intricate blend of all of that.
Okay. Okay. And would they put that as transportation, or if they're giving it to their CPA, would they break it down like, this is my Lyft costs for this year, this is my, let's say they had to rent a car, I don't know, a couple times to get someplace. Would they break it down like that and give it to you that way? Just these are the breakdown for these different ways to transport.
Yeah, that I did. We don't need to see Uber versus Lyft versus some other thing, but it'd be more like just public transportation, Uber, kind of like local transports versus automobile expenses and things like that.
Okay. And then when does, one thing, like as a yoga teacher, Do you encourage them to go to the courthouse and officially become a business in and of themselves, like doing business as being a sole proprietor? So and then do you recommend that they like open up a separate account so they have their own costs, but then they also have separate, they do like their business transactions with a separate account? What would you recommend?
Yeah, so there's two parts in that question. One was, do you need to register with the county that you're in and to have your own business? And technically, yes. If you're going to ask me that question, I kind of almost have to say yes.
Mhm.
So, but you don't need to get a DBA and stuff like that. So if it's under your own name and you're just your own person, you don't need to have a DBA to be called something else unless you're trying to promote yourself as something else. If you were instead, like for example, before I formed a corporation for my business, I was Joshua Cooper CPA, but I also have a branding called Tax Lovin'. And so I ended up having to get a DBA under Tax Lovin' because people were writing checks to Tax Lovin' instead of Joshua Cooper CPA. So to make it easier, the DBA is used for two purposes. One, so people could write checks to and you could actually take it to a bank and deposit it, or you're going to market yourself in a different way. So if you don't need that kind of thing because it's just your name, then you don't need to get a DBA.
Okay.
Registering for the county under a business, you probably should do so. It's almost a requirement by most counties. The second part of your question was separate bank account. Again, this depends on what kind of transactions you have going on. You don't necessarily need to have a separate bank account. It's easier, it's cleaner to do so, but a lot of people just at the end of the year print their bank statements and just highlight the ones that are business related and start to categorize those. That may be all you need at first, and as things progress, and definitely if you ever formed an entity like an LLC or a corporation or opened up your own studio, that's a different story. Then it definitely should have its own bank account.
hmm Can you also delve in a little bit deeper about the S corp and LLC and all that jazz, and when someone might go from being a sole proprietor to one of these other titles?
Yeah. So if you are running your own business, one thing that is important is liability and protecting yourself in this realm of like almost like insurance. And the first tier of that is just having liability insurance. I mean, the Yoga Alliance even just has one that a lot of yoga teachers have. That's kind of like tier one of like you're covered, but there are things they wouldn't cover as well. So, but when you start to have a lot more clients and you start to become a little bit more concerned about protecting yourself, then you would look into one of these other entities like an LLC. That's like next stage up is like an LLC. And that is the simplest way to do it. And that stands for limited liability company. You're not a corporation. That's tier 3. So like that middle tier is just forming an LLC. And depending on what state you live in, there are annual fees to have that. And if it's just you and you have an LLC, it's almost simply a additional insurance policy.
Mm-hmm.
So there's no tax savings of just forming an LLC. It's more just additional liability protection, meaning that if someone came and tried to sue you in any situation for something and your liability insurance wouldn't cover it because of, I don't know, maybe negligence was proven in some strange legal battle, then the assets of the LLC are the only thing available to go, and your like personal assets aren't affected. So if you own a house or even your car or had some big things, the LLC kind of puts up a wall there to protect you. So a lot of small, but it can be costly to have an LLC. In California, it's $800 a year to have an LLC. So some people are like, whoa, that's a lot of money, and it is. So it has to make sense, but it also gives a peace of mind as well. Tier 3 is this corporation world. And so like S corporation, which is what you mentioned, is usually the most common in that tier. There's a C corporation as well, but let's say you have an S corporation. That is the same sort of liability protection. You're just more it's a little bit more complicated because now you have a whole nother entity. When you have an LLC and it's just you, it can be sort of disregarded, and for IRS purposes and things like that, it's almost, there's no additional tax returns that need to be filed. They keep things pretty simple. That's why the LLC is so popular, because you can do things pretty simply. As soon as you get into this corporation world, then it files its own tax returns. There's a whole, you have to be an employee of your own S corporation and have like usually a payroll service and stuff like that. So it starts to get a little bit more complicated. So some people energetically, they're not into that for that complicated reason. But it can make sense if you're making, certainly if you're making enough money too, if you're making anywhere $150,000, $200,000, maybe it starts to make sense, because you have to now pay to have not only have this tax return filed, but you have to pay for the payroll, etc. But there are some loopholes inside the S corporation, which is why the S corporation is so popular. And that is that the net income of the S corporation, and I'll talk about what net income is here shortly, but basically your income, your bottom line income number from an S corporation is not subject to self-employment tax. Over here, when you're just like a self-employed person, you've got your income, you've got all your expenses, and your bottom line number is subject to self-employment tax and regular income tax. So it's a lot of people get stung on how much they owe each year, even if they only made $10,000 in the year. At the end of the day, they might still owe, two of it to taxes, and it's mind-blowing. But it's mostly from self-employment tax, which is really made up of Social Security and Medicare, and you're paying into that system, supposedly. But that's what that is. With an S corporation, your bottom line number still flows through to your personal tax return, but it's not subject to self-employment tax. So in one sense, everyone's like, oh my God, that's huge. But when you have an S corporation, you still have to pay yourself a salary. You can't have it all skirt through this system of no self-employment tax. And anything you pay yourself in salary is getting charged self-employment, Social Security and Medicare, like every W-2 you normally get, also has Social Security and Medicare tax taken out. So there's a delicate dance between, if you have an S corporation, how much to pay yourself a salary and how much to run through this other kind of system, which is taxed a little bit less. And there are guidelines there. You have to generally pay yourself through salary more than what you're getting back in these sort of distributions that are getting taxed less. So it's a little intricate there. For years, people were like, S corporations are great. They weren't even putting themselves on salary at all. And the IRS would audit those people because they're like, you're missing one requirement, which is like you have to be on salary. And then years later, people were just running a $5,000 salary and having $50,000 run through this bottom line. And that doesn't work either. The IRS basically said your salary has to be reasonable based on what you're doing, your industry, and how much you're taking out. So that's where they left it. And so we kind of play around with that every year for S corporation owners.
Now, are the tax write-offs pretty much the same things you can tax write-off for any of those? Are they basically the same type of tax write-offs?
Yeah, your expenses are your expenses. So any place you have your expenses, some people think that if you have an S corporation, you can claim more expenses because you're now a corporation. Maybe, but essentially, the same expenses can land in both arenas and be completely fine.
Okay, I have a question for you. So to make it a little more complicated and interesting, it may not be that complicated. What if there is a teacher, let's say, who lives in the U.S., who, and most of their transactions happen here, but then they also started teaching internationally and they're being paid internationally. How does that affect the way they do their taxes?
Yeah, so let's say that it is a U.S. citizen and they travel and spend like a month of their year teaching in Ireland or Bali or something like that. In the U.S., on your U.S. tax return, you would claim all your worldwide income. That's the requirement. You claim your worldwide income and you claim your expenses related to that income. So, which would be your airfare, your lodging, everything over there that they didn't reimburse you for. You can't claim an expense if you're reimbursed for it. But, and then if you had to pay tax in that foreign country, you could write that off as a foreign tax paid and get a credit for it back in the US. There are certain treaties and things like that that exist. So like if you were teaching in Japan, for example, a lot of yoga teachers will get onto that circuit. And if you do, there are some actual exemption forms so you don't have to pay tax there due to certain treaties. So depending on what country you go to, they may not be required to withhold tax. But if they did, you could claim it as a tax credit on your US tax return anyway.
Okay. And speaking of like people who teach internationally, they don't just teach in the US, or they aren't US citizens, are the taxes relatively, is it really skewed? Is it really different based on, no matter if you live in Canada or you're in South America or Japan or Singapore, like are the taxes relatively the same, or is it are they very different based on country to country?
Yeah, they're all over the place. Mm-hmm. And so, like I said, some are tax exempt based on a treaty with the United States, and some are extremely high. Like in the UK, it's even higher than oftentimes it is in the US. So, and oftentimes it's lower. You know, the South America has got lower, well, it depends what part. But, you know, it's so there's kind of all over the place.
Mm-hmm. But do you think they can probably, I mean, I know the world is a really big place. Do you think that most of these teachers, no matter where they live, do you think these are some of the same things that they could potentially write off depending on where they live or who?
Yeah, same concept of like,
okay.
So like if you had to stay there, you would have your lodging, meals, entertainment, supplies, uniform. It's all kind of the same expense categories no matter where you're teaching.
Mm-hmm. And if someone was actually looking for a CPA to work with, are there any recommendations that you would suggest someone look for and trying to find a CPA?
I think that
certain things like,
if you're looking for a CPA, I think you would want to make sure that they are experienced with sole proprietorships or LLCs or S corporations, whatever you're dealing with. First and foremost, make sure they understand that structure, which hopefully they would. And part two would be if they have any experience in the yoga world, because there's a lot of things that certain CPAs are oblivious to if they don't understand the yoga industry, mm-hmm. like uniform expenses and things like that. So if it was a CPA who had never done a tax return for a yoga teacher and they saw this uniform expenses, they may not even take it because it's something that most industries can't take, or they see some huge travel and they assume that that had to be personal because who spends that kind of money on travel? You know, so you want to make sure that they fully understand how much of your world is a write-off. So sometimes you can train the CPA to understand what's going on if you're fully engaged with it, but part of the reason you're even hiring the CPA so they could suggest other expenses that you can take that you might be missing. So having some experience with that would make a lot of sense. And their fees, you don't want them to be astronomically high. It's good to shop around, but you obviously want to make sure that you're not just picking the cheapest version of what you have going on because, well, it may not suit you in the long run.
Mm-hmm, mm-hmm. And then what about from state to state, just say in the United States, like you live in California, and let's say someone lives in Texas. Can they use you as a CPA, or do you have to stay within your own state?
No, you can get a CPA from anywhere, really. I've got clients all over the United States.
Wow, well, good.
North Carolina, Florida. And so that's not necessarily a requirement, though it is important that if you're using a CPA that is out of state, that they really understand the state you're in. So you can use them. So like, for example, I've got a lot of clients in New York, and I'm in California. I've got to really understand New York taxes because they're very different from California. You know, there's New York City taxes and state taxes and the IRS taxes. So you just have to make sure that they understand the intricacies and some specific tax credits that may be available to your particular state. But generally, a good CPA could file taxes from any state.
Okay. Yeah. So are there any other essential tidbits you think we should know as yoga teachers or potential yoga enthusiasts, potential studio owners, etc.?
Yeah, I think the biggest tip that I would probably give is that, you know, when you're embarking down the journey of keeping track of your business numbers, inherently there's a fear factor that comes up for yogis, and that is that they don't want to deal with money. They want to just be in the spiritual plane and not on the earthly grounded plane. And because of that, oftentimes people will not even look at this stuff until the end of the year, until they have to file tax returns kind of thing. And sometimes that works. It's definitely an ends to a mean, but or means to an end, but it's there's a different way to have a relationship. And that's what I was talking about at first. There's a practice that you can set up, kind of like your yoga practice. You can have your accounting and bookkeeping practice where, like, a certain part of your day or week, you touch base with your numbers, you plug in your expenses wherever you're doing that. And so you can have a relationship with your finances that is a little bit more grounding and established. And most people, when they get over that hump of like, oh my God, I'm not good at numbers, fear, it's not that complicated. And there's a huge empowerment that comes up when you're starting to pay attention to how much money am I making on a monthly basis, you know? And so that's what I would probably say is the biggest tool that yogis can do is to embrace their finances, plan for taxes, and really be proactive for it. And you're going to make mistakes similar to, like, if you're trying to do a intricate balance pose, you're going to fall out of it. You may do it for a while, and you may take a yoga class and realize the last 3 years of you doing that pose was incorrectly. And you make this one tweak, and all of a sudden now your big toe mount that has to be grounded a little bit more. Same happens in this tax world and the accounting world, where it's like you may think that you're doing everything great, and then you want to, like, consult and do all sorts of things and realize, oh, I never knew I could deduct that. Well, you don't have to belittle yourself for not knowing that in the first place. You just move forward and keep getting more and more intricate. But it's a constant learning process similar to the yoga world. So enjoy the journey.
Yeah. So would you recommend that we keep all of our receipts, or do you recommend, as you said, like maybe going through a bank statement once a week or once a month and highlighting things, or having an Excel spreadsheet, or how would you say that we do our bookkeeping and records?
I mean, there's a few different ways to do it. So I mean, like, you would keep receipts for things that you paid for in cash and things that it'd be hard to prove if you didn't have a receipt. If it's showing up on a bank statement or a credit card statement, that kind of can act as your receipt. The IRS would accept that as proof of payment, though sometimes when it lands on a bank statement or a credit card statement, it may just say Amazon, and there's no proof of what it was. So you would want, but oftentimes if you're buying it through Amazon or something like that, there's some email proof of it, which would be backup as well. There's not an actual paper receipt. But you'd want to be able to prove exactly what it is that you paid for. And so but especially with cash stuff. So you generally do, and so that is I see that the most when people travel abroad and are traveling foreign. It's all paid in cash usually. A lot of people are using credit cards too, so they'll come back with a wad of receipts. And then as far as keeping track of what it was you spent on, it depends on how many things you have going on, whether or not you just keep it on an Excel document and kind of list things out, or you get QuickBooks or QuickBooks Online and you kind of download your transactions and categorize them. It all works. It just depends on what is going to work for you and what you have going on. I mean, I would recommend QuickBooks or one of those accounting softwares, Xero, or one of those guys for everyone, but a lot of people, it's too much for them. They don't really want to learn a software that when they can just keep track of their meal expenses on an Excel document.
Mm-hmm.
Whichever works for you is totally fine. And then there's always the hand write it down on a piece of notebook paper, which a lot of my yoga teachers do with pictures all over the expenses and things like that. So as long as it's accurate, that's the most important thing. But yeah, it's kind of, I think as your business matures and as it becomes more and more successful, you would see a natural evolution to eventually using an accounting software because it's just going to be easier than hand typing in every single transaction. You'll want the assistance of like an instant download type of thing.
Mm-hmm. Oh, that makes sense. That makes sense because I feel like that, like right around the tax time, I feel like I'm just pulling from everything. You know, I look at everything and whatever else, and as you're saying, it makes it so much easier when you do it like that week or that month or whatever else. And also, yeah, I was wondering about the receipts, but it makes sense that if you have your bank statement, it's fine, you know, but if you're doing more of the cash transactions, you need to keep those receipts. So.
Yeah, and generally you want to keep them for 3 years.
Okay.
5 years. After 5 years, you can kind of get rid of anything.
Okay. Yeah. So now, are you taking on any new clients?
I am.
Well, good. Well, and how can people find out more about you if they want to seek out you, if they live in the U.S. and they want to seek out you as their CPA?
Find me on my website, www.taxlovin.com, TAXLOVIN.com, and then we'll connect that way.
All right. All right. Well, thank you so much, Joshua. It's so great having you here. I appreciate all your valuable information. And you will be hearing from me very soon with my own tax stuff.
It sounds great. It was great talking with you as well.
You too. All right. Thank you so much. And yeah, thank you for being with us.